Hey traders, Nick here. Wanted to look at the industrials. I know I've touched on them a lot over the years, but recently I've upped the ante a little bit using the XLI just because I personally traded it on the long side because it has a collection of good stocks in there that have been beaten up pretty badly. So XLI is the basically mimics the industrials. It's a big blanket of stocks, but let me see if I can show you a cross section. Boeing, GE, forget that guy. 3M, Honeywell. I don't know a lot about Union Pacific. UTX, I do know. Caterpillar, I do know. Lockheed Martin, I do know. So I'm going to concentrate on these guys. Basically, BA, a little bit of Honeywell. I'll revisit this guy, Caterpillar, and Lockheed, and UTX. So here's the idea. First of all, the macro environment. What does the word look like? Fundamentally, I still like it. You know all the reasons. I tell you that every day. Technically, I also tell you that every day. So it is looking still, in the middle of the range, but with upward bias, higher lows, and why haven't we retested the lows and all of that? So absent headlines, the fundamentals should win over the scary headlines that have been lingering for a while. So having said that, looking at the industrials, the reason why I thought they were great, because for a period of time when Trump became anti-stocks by making these tweets and comments that scared everybody with tariffs and all of that, the stocks that got beaten up, some of them were defense stocks. So those were considered the ones that, okay, these are a Trump trade regardless, because he's always said strong the U.S., defend the U.S., and causing trouble, so that should benefit the defensive stocks, unfortunately. So Lockheed Martin is one. BA also touches up on that one. So those were good longs. I went long those, but shortly thereafter, they got hated. End of April, I think, last week or so, they just sold hard like they were poison. Technically, we tracked them, and this was the technical. I drew this ahead of time, and look how close they came to it. I wasn't a genius in predicting where they were going to stop. I just looked to the left, and that was the last battle zone. So the level stuck out to me. So this is a pivot point for a long time. And there are decent values at that level, given the traditional sense of looking at value from the price to earnings. These are quality companies that have big, long visibility on sales and costs. Anyway, there were a lot of reasons that markets sold them off, and I think they were good buys. Luckily, we've been long a few, and if somebody hasn't done it, here's a chance to do it. But you have to know that this is under the umbrella of markets will be higher down the line. Okay, and I like to leave time on the clock, meaning whatever bet I make, I don't want it to die in a couple of days. So I can trade the XLI all by itself. This is a sector fund. Think of it as an ETF that just mimics the price of all of them, but it's heavily influenced by these guys. So 8% of it is Boeing all by itself. And tariff wars are bad for Boeing because it's in the line of fire with China, right? So that's one. GE is 5.5%, which is unfortunate from one perspective, but from the other perspective, how low can GE go, right? So a lot of the froth has been shaken out of it. So it's closer to a bottom than a top, right? These guys are just quality, solid. FDX and UPS probably have some extra headlines from Amazon. I don't know why they put them in here. I guess they transport all the stuff. But nevertheless, they're there, and they are quality companies as well. So having said that, I can buy a debit call spread. First of all, I can buy the XLI at $73 per share. Or I can risk less money and still participate at a bigger percentage, because options always pay more in interest, not in interest, in percentage terms, as long as we guess the correct directions. So if I buy the stock, and the stock jumps 5% overnight, hey, I'm up 5%. I bet you the earnings will be up 400%. The options will be up 400%. But the problem is, if it falls, yeah, you lose a little bit of money on the stock on paper. Same with the options, but the stock doesn't expire with time, whereas the option does. So that's why sometimes people like to buy the stock versus the option. To eliminate that, or not to eliminate it, to minimize it, I pay up for the options. I don't play next week's options. I go out in time, especially if I have a thesis. So here, I have a thesis that things are going to get better for this group. So I get long it via debit call spread at the money or near the money, currently where it's trading. And I take it at least for June. This way I have a month and a half for it to play out, or to August, or even to September. It doesn't matter. The problem is going out too far, then the profits come slower. So if I own a June or July call or call spread and stock rallies, then my profits come very, very fast. Whereas the ones out in time, I still profit, but at a slower rate. But I also lose at a slower rate. So you see, it's preference, schedule, activity level. All these come into play as to which ones I choose. So I'm going to share, hopefully in the table if I have time, some ideas of debit call spreads or credit put spreads, which is also the same bullish trade direction. It's a directional bet that it will be higher, but by selling puts, meaning I want to sell risk under there. So if price stays above the risk I sell, the money it becomes mine. Otherwise, it's a liability on my books until it expires worthless in my favor. So basically, somebody buys a lottery ticket from me and they lose. I keep the premium. Or somebody buys insurance from me and they lose. So that's the idea of it. I can do both and be really long right here. So if somebody is really aggressive, they can buy the calls and sell the puts. And the second least aggressive, second most aggressive is buying a debit call spread and selling credit put spread. And then the other method is either selling puts or selling put spreads or buying calls or buying call spreads. So plenty of ways of doing this. Now I can do it in the XLI and throw a blanket over all of them, or pick and choose. So Caterpillar owes me some money. How so? I had a good trade going and I kind of messed up managing it, so I wanted to get back at it. It's in the headlines, and it owes me money because it caused all the ruckus when right here, the stock spiked sharply on earnings, and we're talking and then the CFO said, I've said this before, the CFO said that this is as good as it gets, basically, after just raising guidance down the line. Obviously a mistake, a bad choice of words, and the stock just collapsed. Not only that, it caused this new meme to surface that this is as good as it gets for all the earnings, and ruined the whole earnings period. I kid you not, the whole earnings period just got ruined because of Caterpillar. The reaction was positive, and then the CEO himself told us that this is as good as it gets. And suddenly every expert on CNBC and in the media singing the same tune, this is as good as it gets. That's the top. Very shocking, but it happened. So here it is clawing its way back. But it's fighting that big candle. Let me see if I can get clarity as to the levels. You can see clearly like a point in time where I'm going to go 30 minutes. That's that same candle we were looking at. How it's like, oh, spike, high, higher, and then, wait, what? Forget it. Now it's inching back up. Technically, it's kind of a frisky situation here as long as the momentum carries. So you can see lower highs are trying to be breached. And I can make an argument that they're making headway into this giant candle at a good pace. Like there's a little gap here, so the fear is pricing back out, I should say, and the bids are coming back in. So that's one, but it's not as obvious as it could be. But nevertheless, I went long Caterpillar. I bought calls. I actually bought calls and call spreads, but not saying that I'm really aggressive. They're out in time, and I'll share them with you in the write-up. Okay, that's for that. LMT, I'm long. I went long. I added to my longs on the drop by selling puts, but that's an aggressive way of doing it. I sold puts at 260, so yes, long way below, but still it could happen, right? So I committed that I would buy it here and collected some premium there. I did share these before, but now I'm sharing via video. I could have done credit put spreads. In fact, I did do it in a credit put spread in an account I don't like to manage often. It's just kind of like an island account. So it's kind of like a set it and forget it type of a deal. I think they were out to September, but I'll share the write-ups. And here it is back at a pivotal point. So I do like Lockheed Martin. Good company. I think they said some few things in the earnings report that weren't excellent, but nevertheless, it's an identifiable issue and they will fix it. So pivot point, right? Resistance, breakout, support, loss, and here back at it. What will happen? This is a weekly candle. So let me zoom back to the daily candle. That is aggressive, right? But brings it back to the scene of the crime or the accident scene. It still has some room, maybe to 327, 330. So a break above it, then the bulls can say, you know what, we just retook the neckline from which we just fell apart, and hey, we continue. This red blue here is just a regression, just straight up mathematical regression. So if somebody says reverting to the mean, there should be more upside room. Now again, all of this is under the umbrella that the market in general is going to be end or higher. All right, that's one of them. UTX is another one. By the way, UTX and Caterpillar are in the line, and Bank of America and Boeing are in the line of fire of China tariffs. Because they can say, okay, first of all, they can say we're not doing business with the Boeing. We're not buying their planes. I can't imagine they can do that because the only other option is the French company, and then what? So the idea that they can hurt them tremendously going forward, I don't think is realistic. Nevertheless, the headline will cause the stocks to sell off. So keep that in mind. UTX also has elevators and things like that, so they can target them. Plus, should anything happen with the tariffs and their material goes up, like aluminum or steel or whatever the heck they use in order to build their stuff, but that is usually passed down to the clients. They just simply raise the plane cost or the Caterpillar's cost. Here it is, UTX, same tune, right? Coming back to an accident scene. So it could see some whoosh higher. So I am comfortable personally owning any of these calls or call spreads in any of these companies I'm looking at here, minus GE, for a bounce. I can do it with one blanket order or the XLI. I can do it with a whole bunch of little trades, or one of these companies that I particularly like, or a couple. It all depends on personal preference, personal belief in the stock market as it is right here. We are still so close to all-time high that a giant correction is not outrageous. This is the small caps. That is the all-time high. So what is that? Eyeball. Less than 2% off the all-time high in the small caps. So losing a few pennies from here, having a correction is not entirely outrageous. All of these charts I'm sharing will mean nothing if we have an event, and they could happen any day. So industrials, overly beaten down. I mean, they hated them for some reason, and here they are trying to claw their way back. There is an opportunity, and it can be played out. If you have any questions on this, let me know. I'm signing out, and I'm going to try and get a table together by the open tomorrow. I'm doing this on 5/8 in the afternoon after the market closed. So by tomorrow, things may be different, but the concept stays the same unless we have an event changing the game.